Welcome to The Explainer. I am so thrilled you're tuning in today because we are taking on a genuinely massive, absolutely fascinating topic. We're going to completely peel back the onion, layer by layer, to figure out how the stock market ecosystem actually works. You really have to forget everything you've seen in the movies, all those people shouting on trading floors or placing wild, impulsive bets. Today, we're diving into the real mechanics, the hidden psychology, and the actual reasons why those numbers keep flashing green and red on your screen.
But right off the bat, before we get into all those mechanics, I want to pose a somewhat provocative question. Why do most beginners lose money in the stock market? It's kind of a huge mystery that traps literally millions of people every single year. A lot of folks just treat the market like it's a casino, a place to hit the jackpot and make fast, easy money. But as we're going to uncover today, treating it like a casino is exactly why they lose. The market is an entirely different beast, and once you truly see it, your whole perspective is going to shift.
So here's our roadmap for today's deep dive. First, we'll cover the stock market basics. Second, how the machine actually works. Third, trading versus investing. Fourth, we'll expose some hidden market truths. And finally, number 5, building long-term wealth. Let's get right into it.
Starting with part 1, the stock market basics and the ecosystem itself. Why does this massive financial bridge even exist in the first place? Well, it really just boils down to a mutual need. Companies out there desperately need capital to expand their businesses, and everyday people like you and me want to grow our money to beat inflation. The stock market is simply the bridge connecting those two needs.
Now, when you buy a stock, it's super important to remember you aren't just buying a random ticker symbol on an app, you are buying a literal piece of a real-world business. Think of a company, let's say Reliance Industries or Tata Consultancy Services, like a giant pie. If that pie is cut into 100 slices and you own 5 of them, you own 5% of that entire company. You share directly in its massive growth, and on the flip side, if the business performs terribly, you share in that failure too.
To keep track of how all these companies are doing collectively, we use market health meters. The Nifty 50, for instance, tracks the top 50 companies on India's national stock exchange. It's essentially a thermometer for the country's overall market health. Then you have Bank Nifty, which specifically tracks major banking stocks and is heavily influenced by things like Reserve Bank of India policies. When a company first offers its shares to the public to raise money, that happens in the primary market. You've probably heard of IPOs. But the everyday buying and selling of those shares between people, that all happens in what we call the secondary market.
All right, moving on to part 2, how the machine works and the specific mechanics of a trade. Let's look at what literally happens when you decide to press that buy button.
The behind-the-scenes mechanics are honestly incredibly efficient. Picture this. You decide you want to buy 10 shares of Infosys. You place the order on your phone. Instantly, your broker fires that order off to the exchange. Now, at that exact same second, somewhere else in the country, somebody else is trying to sell 10 shares of Infosys. The exchange's entire job is to play matchmaker, linking your buying price with their selling price. The nanosecond those prices match, the trade executes, and ownership transfers electronically. It is a massive, lightning-fast digital auction happening millions of times a day.
But who is actually participating in this auction? Well, there's a huge difference in the players out on this battlefield. First, you've got retail traders. That's just normal folks like us, trading in relatively small volumes. Then you have the heavyweights, institutional investors. We're talking mutual funds, banks, hedge funds. This is the smart money. Their volume is so massive that they literally move the market. Fun fact, institutional investors make up the vast majority of daily trading volume. They're the whales, and we're just kind of swimming in their wake. You also have market makers who provide continuous liquidity to ensure you can always buy or sell instantly. And keeping an eye on this entire operation in India is SEBI, the regulator, acting as the referee to stop fraud and protect investors like us.
So knowing the players is crucial, but so is understanding the size of the pieces on the board. We measure how big a company is using a really simple formula called market capitalization. You literally just multiply the current share price by the total number of shares in existence. So if a share is 100 rupees and there are 1 crore shares out there, the company is worth 100 crore rupees. Simple, right? This is exactly how we categorize companies into large, stable large caps, medium growth mid caps, and those smaller, riskier small caps. Though to be honest, a quick bit of math will tell you that even some of these so-called small caps are worth hundreds of millions.
Okay, part 3. Trading versus investing. This is where you have to choose your style. These are two vastly different approaches. Trading is a short-term game. It demands fast decisions based on technical analysis, intensely studying charts and candlesticks. It's high adrenaline, higher stress, and mostly focused on generating immediate income. Investing is pretty much the exact opposite. It's a long-term game requiring immense patience. You rely on fundamental analysis, poring over a company's revenue, their debt, their actual growth potential. It is a much lower stress approach that's ultimately focused on building lasting generational wealth.
And this stark contrast brings us right back to our opening mystery. Why do so many beginners lose money? Well, retail traders, especially beginners, get obsessively focused on finding the exact perfect entry point. They're always hunting for some magical indicator or a sure-shot strategy. They overtrade and blindly follow tips. But the professionals? The pros don't care about a magical indicator. They focus entirely on managing risk first. They think purely in terms of probability, liquidity, their own psychology, and position sizing. It is a completely different mental framework.
Which leads us perfectly into part 4, the hidden market truths. Let's talk about psychology and liquidity and reveal what truly makes the market tick.
At the most fundamental level, stock prices move strictly because of demand and supply. If there are more buyers than sellers, the price goes up. Simple enough. But what actually drives that demand? Well, it's driven by real-world company profits, massive global news events like elections or wars, and, crucially, raw human emotions: fear, greed, hope. When you stare at a stock chart, you aren't just looking at cold, hard math. You're looking at a visual footprint of human emotion and institutional decisions. The patterns repeat simply because human behavior repeats.
And if there's one thing you take away today, let it be this: the market is not random. Period. Remember those massive whales we talked about, the smart money institutions? They operate with such gargantuan volumes that they can't just casually slip in and out of the market. They need liquidity. They need a huge number of buyers or sellers on the other side of their massive trades to absorb their orders. This is exactly why you see things like stop hunts or fake breakouts. It isn't magic, and it definitely isn't random. It's smart money strategically maneuvering to hunt down the liquidity they desperately need.
All right, finally, part 5, building long-term wealth. Let's talk about the paradigm shift you need to make to succeed.
The real secret weapon for long-term wealth isn't a hot stock tip, it's compounding. Now, don't let the scary-looking math equation throw you off. Compounding is arguably the single most powerful concept in all of finance. It essentially means that your returns start generating their own returns. It's a snowball effect. You don't need to score one massive lucky win. You just need small, consistent growth over a long stretch of time. In that equation, time is literally the exponent. Patience truly does pay.
But to actually let compounding do its thing, we've got to bust some major myths that hold people back. Is the stock market just gambling? Yes, absolutely, if you trade blindly without any knowledge. But once you apply skill and strict risk management, it transforms into a system of probability. Do fancy indicators make you rich? Nope. Pros rely on emotional control and risk management. And do you need a massive pile of money to get started? No way. What you really need right at the start is just the basic skill to survive and not lose what you have.
So I want to slow down here for just a second to leave you with this final thought. The single biggest paradigm shift you'll ever make in your entire financial journey happens the moment you look at the market and finally stop asking the amateur's question: how much money can I make incredibly fast today? True success, the kind that actually builds generational wealth, only begins when you start asking this one absolutely vital question: how much of my capital can I rigorously protect while allowing it to grow steadily over time? Keep your money safe, let the math do the heavy lifting, and the market will shift from being a dangerous casino into your greatest financial tool. Thanks so much for joining me on this deep dive in The Explainer. Keep learning, keep questioning, and I will catch you next time.